Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Tuesday, July 28, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
Yeah, glad to dive into this one because today is, well, it's pretty heavy.
It really is. I mean, if you're holding heavy positions in big tech right now, or, if you're just trying to make sense of the sudden chaos in global markets, you need to be paying close attention today. So we're going to break down the three most critical themes from today's proprietary updates.
Right, and they're all kind of colliding at once.
Exactly. Theme one is this historic rotation going on under the hood of the equities market. We are seeing a really aggressive unwind in AI and momentum trades and a massive rush into cyclicals and defensive.
Which is largely being driven by your second thing. I mean, the surging anxiety ahead of tomorrow's pivotal FOMC meeting.
Right, and that anxiety is being amplified by a contrarian call for a surprise rate hike that we'll get into. And then theme three is just this violent intraday whiplash we saw in crude oil. And what a late-day geopolitical escalation actually means for inflation assets going forward.
So we're mapping out all the dominoes for you, and we really need to start with a macroeconomic picture. The looming July FOMC decision is it's the epicenter of all this anxiety right now.
It is.
If you look at our latest run, the broad institutional consensus has been really heavily positioned for a hawkish hold.
Meaning everyone expects the Fed to keep rates steady, but, maintain tough talk on inflation.
Exactly. But consensus got severely tested today.
Yeah, Citadel Securities published a high-profile prediction for a surprise 25 basis points hike tomorrow under Chairman Kevin Warsh. And the bond market, it reacted instantly.
Oh, immediately. The Treasury market exhibited this distinct bull steepening bias.
We saw the 10-year Treasury yield dip, 4.2 basis points?
Yeah.
Down to 4.608%.
Yeah, and the real action was at the long end. The 30-year led the rally, dropping 4.8 basis points.
But wait, I need to jump in and push back on the fundamental logic of that hike call for a second, because if we look at our daily desk data, the domestic economy is clearly showing signs of cooling.
Well, sure, parts of it.
Today's consumer confidence data completely missed expectations. It came in at 90.8 versus the 92.4 consensus. And that present situation metric, the one within the report, it just hit its lowest level since 2021. So consumers are clearly feeling the pain. Why would Chairman Warsh look at a struggling consumer and say, let's hike rates right now?
It definitely seems counterintuitive, right? But it comes down to establishing supreme inflation-fighting credibility. Chairman Warsh operates very differently than his predecessors. He is highly unpredictable, and he's just intensely focused on these lingering geopolitical supply shocks.
So he's looking past the domestic consumer?
Right. The argument for a surprise hike is that you have to kill the inflation psychology completely, even if it causes some near-term domestic pain.
Yeah.
The bond market is just stuck trying to price in two completely conflicting narratives right now.
A softening domestic consumer versus a central bank chairman who might prioritize global inflation risks above literally everything else.
Exactly.
Let's break this down using first principles, just so you, the listener, can clearly see what the bond market is signaling here. I'm looking at today's data deck, and it shows the 10-year, 2-year spread, so the 20 segs, is positively sloped at plus 31.9 basis points. For a regular investor, what does a steepening curve actually mean in practical terms?
Okay, so think about your standard commercial bank down the street. Their fundamental business model, their profit engine, is borrowing capital at cheap short-term rates.
Like the interest they pay on a checking or savings account.
Right, exactly. And then lending that capital out at higher long-term rates, like a 30-year mortgage. So the wider the gap between that short-term cost and the long-term yield, the more profitable the lending environment becomes.
So a steepening curve, where long-term rates are higher than short-term rates, means that profit engine is working normally.
Correct. It signals a return to a healthy, functioning economy. It implies investors expect future growth, so they demand higher yields to lock up their money for longer. So that positive 31.9 basis points suggests the market is attempting to normalize after that prolonged yield curve inversion we lived through.
But this is exactly where that prediction of a surprise hike throws a wrench into things. Because if Warsh delivers an unexpected 25 basis points hike tomorrow, the front end of the yield curve, the 2-year, is going to reprice sharply higher.
Indeed. And that action could instantly flatten or, even invert the curve all over again. And if you break that traditional banking profit engine, banks restrict lending.
Right, they stop extending credit to small businesses.
Yes, and to consumers.
Hmm.
It rapidly squeezes liquidity out of the system. So what looked like a soft landing transforms into a potential growth shock.
Yeah.
That tail risk is exactly why we're seeing such defensive posturing across equities today.
Moving to today's data, let's examine how those rate dynamics are forcibly rotating equity capital. Because the bifurcation we're seeing under the hood of the stock market it's staggering.
It really is two completely different markets right now.
Yeah, today, the cap-weighted NASDAQ 100 fell 0.98%, putting it, dangerously close to correction territory. Yet the equal-weight S&P 500, the RSP, it surged 1.17%.
Which tells you everything you need to know about the current psychology. I mean, investors aren't abandoning the stock market. They are aggressively abandoning specific, overcrowded trades.
Namely, semiconductors. I mean, NASDAQ's decline today was almost entirely driven by a brutal rout in semis. The Philadelphia Semiconductor Index, the SOX, collapsed 4.49%.
And we can trace that collapse directly back to KLA Corp. They missed their free cash flow estimates late yesterday, and the market punished them. But it dragged the entire supply chain down with it.
Yeah, I'm looking at the board. AMD dropped 8.15%, Applied Materials fell 7.82%, Micron lost 8.85%. Why does a cash flow miss from KLA cause a meltdown in the whole ecosystem?
Well, you have to look at what KLA Corp actually does. They don't design the flashy AI chips. They manufacture the complex capital equipment required to fabricate those chips.
So they're the picks and shovels.
Exactly, the ultimate picks and shovels of the AI gold rush. So when KLA's free cash flow misses estimates, it sends a terrifying signal. This massive corporate spending on AI infrastructure might be hitting a bottleneck.
Right. If the equipment maker sees a slowdown, the downstream chip makers are going to see it next.
Yeah, and the market just immediately repriced the entire ecosystem to account for that constrained growth.
And that repricing triggered a severe global contagion event. According to today's proprietary updates, the South Korean index, the Kospi, suffered an extreme 10.84% drop overnight. I mean, an almost 11% drop in a major national index in a single session.
It's a historic wipeout, a total bloodbath.
Yeah.
And it perfectly illustrates the danger of leverage in these markets. The Kospi is heavily weighted toward memory chip manufacturers, making it ground zero for foreign capital flight.
Because SK Hynix missed their operating profit estimates, right?
Right.
But by a mere 7%.
Right. In a normal environment, a 7% miss might cause, a mild pullback. But here, it triggered a massive wave of foreign net selling.
Because leverage forces your hand.
Correct. When institutional investors apply massive amounts of borrowed money to a specific sector, they don't have the luxury of waiting out a dip. A minor fundamental disappointment triggers margin calls.
Lenders demand their capital back.
Yep, which causes rapid forced liquidations. Samsung also faced intense foreign outflows overnight for the same reason. Leverage accelerates gains on the way up, but it acts as an indiscriminate wrecking ball on the way down.
So, if capital is fleeing high beta hardware and memory stocks at this historic pace, where is it going?
Well, looking at our daily desk data, defensive sectors are catching massive bids.
People want predictable cash-flowing assets right now.
Right. IQVIA surged 13.9% today on raised guidance, which dragged the whole healthcare sector higher. Over in Europe, Unilever jumped 8.6% on strong sales data. We can actually quantify the scale of this migration, too. Analyzing prime brokerage flow from today's data deck, we are currently witnessing the largest long selling in global information technology since January 2021.
Oh, wow. Sorry. I mean, that is huge.
Yeah, hedge funds are aggressively de-risking their portfolios. Gross leverage across the system is down 13.5 points just since late May.
So that's a structural reduction in risk appetite, not just a one-day tactical shift. But here's the piece of the puzzle that might confuse you if you only glance at the headlines. Despite this historic unwinding in tech, the broader market remained oddly calm on the surface. The S&P 500 managed to close in the green at 7,428.78. Given the carnage in semis, how did the floor not fall out of the broader index?
It's a great question, and the answer lies entirely in options mechanics. According to our latest run, there was a massive wall of dealer positioning sitting right around the 7,400 level on the S&P.
Okay, let's unpack that mechanism for the listener. What does it mean when options dealers dictate the floor?
So think of options dealers as the market's mechanical shock absorbers. They sell options to investors, but their goal isn't to bet on the market going up or down. Their goal is to remain market neutral and just collect the premium.
Right.
And right now, we are in what's called a short gamma regime. In this specific environment, options dealers are mathematically forced by their internal risk models to trade against the prevailing market momentum just to keep their books balanced.
So as the aggressive selling in semiconductors dragged the broader S&P lower toward that 7,400 level, those dealers were mechanically obligated to step in and buy stocks.
Indeed, their hedging requirements created an artificial mechanical floor. The selling pressure from tech was heavy, but it wasn't heavy enough in the aggregate to overwhelm those shock absorbers and break through 7,400.
So instead of a cascading sell-off, the short gamma dealers bought every intraday dip, forcing the index into a quiet, range-bound drift.
Yeah, it completely masked the underlying turmoil taking place at the sector level.
On that point, we need to pivot and examine how this equity rotation and macroeconomic uncertainty are violently colliding in the commodities market. Energy and safe haven metals experienced significant whiplash today.
Whiplash is the right word for it.
During the regular session, WTI crude cratered 3.39%, dropping down to $79.13 per barrel.
And that intraday decline in crude oil was actually the primary driver of the relief rally we saw in the Treasury market earlier in the day. The crude sell-off was driven by widespread market optimism over diplomatic talks between the U.S. and Iran, pointing toward a de facto ceasefire.
Right, because when you see crude drop that sharply, it immediately erodes the geopolitical risk premium.
Yeah, and it significantly lowers near-term inflation expectations.
But the smart money was clearly hedging its bets. While energy dropped, hard assets remained fiercely bid. Gold is trading at historically elevated levels, sitting at $4,029 an ounce today. It's acting as a persistent hedge against both geopolitical instability and sticky inflation. And copper is holding steady at $13,759.50 a ton, basically in a holding pattern, as traders await clear demand signals out of China.
The gold dynamic is what you really need to pay attention to, though. It suggests that even as crude sold off intraday on peace talks, sophisticated capital was not fully buying the diplomatic relief narrative. They maintained massive, expensive hedges in precious metals.
And their skepticism was entirely validated, which brings me to a critical update from our evening data run. The intraday narrative on oil has completely reversed. In after-hours trading, WTI crude spiked over 4%, surging to roughly $82.75 per barrel.
Right, what was the catalyst there?
News broke just after the closing bell that the U.S. military intercepted an Iranian attempted surprise attack. The diplomatic optimism that drove prices down during the day just vanished in a matter of seconds.
Which completely unravels the intraday inflation relief trade we just discussed. I mean, think about the psychological whiplash for a trader managing energy equities today. During the regular session, energy equities were the worst performing sector. The energy ETF, XLE, dropped 1.35%.
Because investors dumped energy under the assumption that tensions were cooling.
Right, but this sudden overnight spike in crude sets the stage for a violent upward reversal at tomorrow's open.
The market priced in peace at 3:40 p.m., and it's waking up to a military escalation.
Correct. And a 4% spike in crude oil reinserts the inflation premium directly back into the financial system on the exact morning the Federal Reserve meets to decide on interest rates.
Which puts maximum pressure on the bond market, severely complicates the Fed's inflation math, and fully validates the heavy defensive posture we're seeing in gold. Understood. Let's synthesize all these moving parts so you have a clear roadmap of what is actually happening. We have a yield curve trying to steepen but facing a hawkish threat from the Fed. We have a historic, leverage-driven equity rotation out of technology and into boring, predictable defensives. And we have commodities violently whipsawing on geopolitical news. When we connect these dominoes, what is the new market regime telling us?
It tells us we are witnessing a fundamental shift in the primary narrative of the market. For the past year, the market has been entirely obsessed with a micro single-stock narrative.
Right. Questions like, who has the best AI chips?
Yeah, or which company is securing the most data center contracts? The broader economic environment was largely ignored because the market was priced for perfection. We assumed a soft economic landing combined with endlessly cheap liquidity.
Which is an environment tailored perfectly for mega-cap tech growth.
Exactly. But that perfect environment is breaking down in real time. We are transitioning to a macro aggregate narrative. The new question is much broader. Can the global economy actually handle these elevated interest rates, heavily indebted consumers, and sudden commodity supply shocks?
The market can no longer afford to ignore the cost of capital. And our daily desk data provides a really notable metric to illustrate this exact shift. Right now, single stock correlation is sitting at near multi-decade lows of just 9%.
Which means the performance of one stock has had almost zero bearing on the performance of another. It's been the ultimate stock picker's market.
Right, but that 9% correlation is the mathematical footprint of a highly selective, micro-driven market. As capital aggressively flees crowded tech trades and seeks yield and safety in materials like Nucor or consumer staples like Coca-Cola, that correlation is bound to rise.
And when overarching macroeconomic factors, like a surprise Fed hike or a 4% oil shock, become the dominant drivers of fear, stocks begin to move together in tandem. A rising correlation regime is highly disruptive for funds that rely on sector dispersion. It confirms that the macro environment is firmly back in the driver's seat.
Which leaves you with a critical, forward-looking question to mull over tonight, especially regarding the sheer scale of the technology build-out we mentioned at the start. Based on our desk data's projections regarding hyperscaler debt, major technology firms are projected to spend over $1.5 trillion on capital expenditures by 2030 just to build out this AI infrastructure.
It's a massive undertaking that, despite their heavy cash reserves, is still heavily reliant on debt financing in the corporate bond market.
Exactly. So if Chairman Warsh and the Federal Reserve actually deliver a surprise rate hike tomorrow and corporate credit spreads begin to widen, making borrowing significantly more expensive across the board, will the much-hyped AI infrastructure build-out hit a sudden structural funding wall?
It is the trillion-dollar question that the semiconductor rout today suggests the market is already beginning to ask.
Thank you for listening to Market Pulse by Orestes Capital, where Elena and Marcus will be back tomorrow with the latest market color.